Hello, everybody, and welcome to our virtual briefing today. I hope you're all keeping well. As you may have noticed, we're trying out a new format today, so hopefully you've all logged on successfully using Vimeo instead of Teams. We're interested in anyone's feedback as to how that works for you. As usual, we'll be sending a survey following our briefing to gather feedback, so please do complete that, and there will be spot prizes again for those who do. We'll also today, as part of our new Vimeo feedback, Vimeo approach, be including some polls throughout. So hopefully on your screen you can see a chat feature and a Q&A feature and a polls feature. So we'll be showing some polls there during our briefing today. And at the end, we will be taking any Q&A. So feel free to submit questions throughout our presentations today, and I can compile them and put them to our speakers at the end. So we'll start promptly as usual to make sure we get you out on time. This session is verifiable for CPD. Hopefully you got the option on entering to put in your email address, and we'll have a record then of your attendance. To start today, we'll have Patrick Meegan discussing Solvency II and some changes that we can expect there over the coming year or so. Next, we'll have Owen King talking about the ORSA and in particular any COVID-19 related considerations. And finally, we'll have Eamon Phelan discussing key risk indicators. So I will hand you over now. Please feel free to submit questions, as I said, and we'll have a quick Q&A then at the end to go through those. Thank you.
Thanks very much, Aisling, and good afternoon, everyone. Hopefully my sound is working. Otherwise, I'll be talking to myself for the next 15 minutes. So I'm delighted to be presenting to you today. I even went to the full effort of putting on my full suit and tie, as you can see. And you've actually a typo on my name there. It's EN at the end. The presentation, it can feel a bit strange, I suppose, when you're at home presenting to your screen. I know it's a bit hard as well listening to a screen. So as Ashley said, we've tried to kind of make it a bit more interactive. We'll have Q&A at the end, but we're going to kick off with a survey first. So if you could look to the left of your screen and click on the polls link there and answer the first two poll questions, please, as they're relevant to my session. So I'm going to be talking about Solvency II, so what has happened this year and also what to expect for next year. And again, I thought that before I dived in, it might be useful to first gauge your expectations on this topic. So the two questions I'd like to ask are, one, how much do you expect the Solvency II requirements to change over 2021? Not at all. A few minor updates, a moderate amount of changes, a considerable amount of changes. And question two, when do you expect the Solvency II 2020 review changes to come into effect in Ireland? So do you think that'll be 2020, 2021, 2022, or 2023 plus? So if you fill that out of your leisure, I'll hopefully return to that at the end of my slot and we can check out what the results are at. Another thing, I suppose, when we were talking about the session, trying to make it a bit more interactive, it got me thinking. So I suppose usually at this point, just at the start of a Solvency II presentation, you'd all be feeling that electric excitement in the air. And unfortunately, we're all missing out on that today. But I've taken things a small step further and kind of taken the somewhat unorthodox decision to provide my own audience. So it's kind of like watching soccer on TV, with those fake sounds from the crowd. So I suppose from here on in, you can probably expect a lot of cheering and clapping because I've a fairly good idea that I think my audience is going to love this presentation. Moving on then, maybe kind of to start, if you cast your mind back to the start of the year, remember when we were talking about who was going to win the general election and, what was next government going to look at? What were your plans for 2020? Maybe you were going to go on holidays. Maybe you thought I might go to a party, I could go to a festival even. Perhaps you're going to go see a few matches. Or, maybe it was just something as simple as, you wanted to go see your grandparents. Well, obviously, all of that didn't quite transpire as we thought it was going to. But I suppose it's important to remember as well that, everyone's been impacted by the pandemic, and that includes Solvency II. Solvency II had big plans for 2020 as well. The Solvency II directive specified that certain aspects had to be reviewed by the Commission by the 1st of January 2021. So that covered areas like long-term guarantee measures, so those controversial matching adjustment, volatility adjustment, and extrapolation methods, as well as some equity risk measures like the symmetric adjustment. The SCR was another area that was under consideration, and I suppose that impacts a lot of companies. So the Commission are required to look at the methods, assumptions, and parameters of the standard formula SCR calculations. And that also extended to the MCR calculation. There were some other items around group supervision and capital management, and these are being looked at. Useful to note that the risk margin was off the table for this particular review, so there was no expectation of changes on that respect. So this was all going to plan, I suppose. EIOPA there'd been a call for advice that went out early 2019. There was 2 consultations. One happened mid-2019 and the other was kind of spanning the end of 2019 and into 2020. There was an impact assessment, as you can see, taking place in March. And all of this was kind of culminating with EIOPA planning to provide their final advice to the Commission on the 30th of June 2020. And that would leave the Commission plenty of time so that they could get the report out by the end of the year. Well, what happened then? Well, I can't remember the exact wording of the speech, but I'm pretty sure in Leo's speech back in March when he was announcing the first lockdown, what he said was Solvency II, stay at home. Let me give myself a little laugh for that. So what has Solvency II been up to during the pandemic? The answer really is, hopefully that's cycling on. The answer is really not that much has changed in Solvency II's life since 2020, since the start of 2020. So the deadline for the information request for the holistic impact assessment was extended by 2 months. So that was pushed back to the 1st of June 2020. There was a supplementary information request, and that was issued to a subset of companies. And again, this was using a reference date of 30th of June. What they were trying to do here was capture some of those COVID impacts. So I suppose if you're going off and revising the SCR, which is showing a lot of 1 in 200 year scenarios, it might make sense to kind of include information or data from a small thing like this big pandemic. So the aim was then to capture that and kind of get feedback from that, maybe do the work in July to mid-September 2020. So as a result of all of that, EIOPA's advice to the European Commission was delayed from the end of June 2020 to the end of December. So I suppose looking forward then, what will 2021 hold in store for Solvency II? Well, like many things, it hopes to catch up on everything that was delayed in 2020. So there's some new proposed regulatory text is expected from the Commission in Q3 of next year. But remember, that's only when the text will be available. So after that, it needs to be agreed by the co-legislators, and after that, it has to be transposed into national law. So that's kind of the update on the 2020 review of Solvency II. So we're kind of at that point of the conversation where you've kind of covered off the main bits of news, and for instance, like, oh, I went to the shops yesterday, and you're desperately going to ask, well, is there any other news? Well, there is and there isn't. So EIOPA are always good for an update to the QRTs, and I suppose in these pandemic times they have delivered again, so give that a cheer. So I suppose, in fact, this really shouldn't come as a surprise. EIOPA are quite good at signposting when the QRT updates will come through, and there's been one every year since the start of Solvency II. So they do publish this timetable, and as you can see, the current update is part of Taxonomy Release 2.5.0, and then the next release is due for July of 2021. Unfortunately, though, this taxonomy is quite a lot lighter than a lot of the previous updates they've updated. Yeah, indeed. So really, it's more of a tidy up is what's kind of going on in this one. So it's nothing really of massive substance in it. So tidying up typos, adding missing bits of information, removing some crossed out boxes, and a bit of stuff around XBRL tagging and Brexit. I mean, there aren't even any new log files, it's just new templates that are slightly revised. So obviously that's a bit of a disappointment for all of you out there. What about the central bank? Anything on the national specific templates? Well, the central bank have come out on this, and again, that's bad news, unfortunately. So there will be no updates to the NSTs, and they kind of confirm that on their website. However, I do have something for you. if it's any use, and it would be actually quite a lot bigger. So they do have a new consultation paper out there. Geez, I don't know what to do with this audience. When I say that some of the updates are cancelled, you're disappointed, or they aren't as big, and then when I say they've got something else you're giving out, I don't know how to keep you happy. Well, anyway, the consultation has happened, so there's nothing you can do about it. So here we are. Central Bank have kind of said that they're pretty sure they're moving ahead with this, and all sign points are that we can expect this coming down the tracks. So recovery and resolution, they've said, is quite a big theme for them, and it is something that's covered as part of the Solvency II 2020 review. But this central bank initiative, I suppose, will bring it into play a bit earlier. So they've set out some regulations and guidelines around this, and most companies are in scope. The medium, high, and high ones will have to submit it to CBI themselves, but the rest of you will have to submit it on request only. It'll need to be reviewed annually and approved by the board as well. And some of the detail, I suppose, there is quite a lot of detail in the consultation paper setting out what's within it, and it even gives a proposed layout of what your recovery plan will cover. So it's got things like governance, strategic analysis, recovery indicators, recovery options, scenario analysis, and communication plans, and so on. So if you are interested in more details on all that stuff, Conor Callahan did a great presentation on at our last briefing session, and we also have a briefing note on it. So it was actually quite a funny presentation from Conor as well. Unfortunately, though, he didn't have a soundboard. So one for next time, Conor. Moving on then, it probably is worth giving a mention to as well to the quarterly SCR calculations. So this is kind of something that came through by the back door during the year. So EIOPA came out and said that they had an expectation during these kind of COVID-19 turbulent times that people will be recalculating the SCR, or at least updating it in some way between quarters. So in the past, you could get away with using your previous value if the risk profile was the same and there's no big changes. And following on from that, the central bank did echo these comments at early September. So the expectation is that you aren't just showing the same SCR figure in your QRTs every quarter. Now, I know that we're all a bit tired of lockdown, but would you be happy if I said we could move on to level 3 now? Obviously, I mean the EIOPA level 3 guidelines when I mentioned level 3 there. So EIOPA have come out with something new on this side. So they've identified the need to develop specific guidance and information and communication technology, security and governance. And they've tied this all in under the Solvency II framework and linking it to those kind of risk management style articles. So this will be live on the 1st of January, the 1st of July 2021. So I can tell you're all very excited about that. So, but keep that cheering up actually, because believe it or not, as part of this, there are actually 25 whole new guidelines. So I'm not going to cover all of these, but you've got loads of great stuff in there. You've got a new policy that you have to create. You've even got a new function. And you have, if I can highlight the function box, you've got stuff there on audit, and there's stuff on business continuity planning, and you even have something there on outsourcing of information communication technology services as well. So really there's fun there for all the family, so that will kind of keep you busy for the next few months as well. So that's been published, so you can kind of look into the detail of that now and get yourself ready for the 1st of July implementation date. So moving on then, I suppose from here, I'm going to give a bit of a, maybe kind of to take us down from all that excitement that we've had. I'm going to talk a small bit about the year-end deadlines. Then I'll go check in on the survey results and I'll do a sign off after that. So the reminder on the deadlines for year-end, most of them are quite similar to last year. So the Q4 QRTs you have to have in maybe a few days into February. The year-end items are all roughly a week into April, and that actually falls just after Easter weekend, but I don't think that actually matters this year because I heard a rumor that Easter was cancelled. And that brings us on to the survey. So just looking at some survey results here, and hopefully they're flashing up on screen for you also. How much do you expect the Solvency II requirements to change over 2021? So 18% saying not at all, 56% saying a few minor updates, 18% saying a moderate amount of changes, and 6% saying a considerable amount of changes. So I suppose we've kind of seen the RAP. It's probably somewhere in the middle, but maybe, and again, it depends on your own company's view of how much you think a minor or major amount is, but there's definitely a bit of work there in it for 2021. So when do you expect the Solvency II 2020 review changes to come into effect in Ireland? And I suppose, yeah, the naming on this can be kind of misleading. The interim 2018 review actually only happened midway through 2019. So 0% of you saying 2020 for that, so I think you're probably fairly safe on that bet. 15% think 2021, 75% 2022, and 9% 2023. So I suppose given that we're kind of expecting some of the regulatory text to come out in kind of Q3 of 2021, and I suppose it all comes down to how much discussion there is on that point between the co-legislators and how quickly then it can be transposed into national law. So I suppose we have a bit of time, but yeah, really no way to definitively tell on that one quite yet. Moving back then to the summary, just before I hand off. So again, to recap, what is there for year-end 2020? So there's some minor changes to the QRTs, no log file changes, and no NST changes, which is all good news. For the future, I suppose what you're looking towards is resolution and recovery planning. That's coming to us in near you soon. Level 3 guidelines on information security, they'll be there in June of 2021. We'll have some more annual changes to QRT scheduled, and hopefully we'll see a bit of progress as well on the delegated regulations, and that's on to 2020 review. So maybe at this stage I might just give you all an opportunity to express your appreciation. And maybe take a little drum roll to introduce you to the next speaker. And that is Owen King.
Thanks, Patrick, for what was a very unique but a very interesting presentation. So this afternoon, I'm going to be talking to you about ORSA and in particular COVID-19 and other considerations. Before I get into the meat of my slides, I'd just like to draw your attention to 2 additional survey questions that you might want to complete that are specific to this presentation. So the first question is a simple yes/no question. It's just, did COVID-19 lead to any significant changes in your ORSA scenarios in 2020? And the second question is whether or not you or your company plan to make further changes to your ORSA scenarios in 2021. And that's a multiple choice question. So do you think your ORSA scenarios are going to be similar to 2020? Do you expect your scenarios to be less severe, possibly because you thought COVID-19 was going to have a more material impact than it actually did? Or because we now seem to have a viable vaccine or 2 that will be available at some point next year? The third option is maybe you think that COVID-19 will need to have more consideration in your ORSA scenarios next year. Maybe you undercooked the impacts this year. And the final option is to say that it's just too early at this point really to make any conclusions as to what your ORSA scenarios are going to look like in 2021. So this morning I'm going to be talking to you, as I said, about the ORSA and in particular COVID-19 considerations. But I suppose just before I get into that, I suppose it's just useful to note that the ORSA has been with us for a number of years now, since Solvency II was introduced in 2020, or in 2016, apologies. And even prior to that, we had the forward-looking assessment of own risk for a number of years during the preparatory phase. And with anything that's been with us a number of years, I guess the question always arises as to how to keep something fresh and relevant. I mean, we've seen the ORSAs for a number of companies, and generally the number of changes to scenarios from one year to the next tend to be relatively minor. But one thing that COVID-19 has possibly taught us is that there are stresses that we might not realize are imminent, emerging risks that can manifest themselves very quickly, a la COVID-19, but also that stresses that we previously thought were uncorrelated can actually happen at the same time, and that's something that maybe companies hadn't previously considered in the ORSA. So I think there's a number of useful lessons that we can take from COVID-19 in that regard. In addition to kind of COVID-19 considerations, there's a number of other things that I'm going to just touch on briefly today. So Patrick mentioned the Solvency II 2020 review. I'm not going to go into that in any detail, but there could be implications for the ORSA that I'll touch on. Climate risk is another particular one that might have implications for ORSA, something that the CBI and EIOPA have mentioned a lot in the past. I'm also going to touch on Brexit and maybe recovery planning as well. Just before I get into talking about those topics, though, I thought it would just be useful to give people an overview of the CBI's current views in relation to the ORSA. So, as many of you probably are aware, the CBI had its 2020 insurance industry briefing last week. And at that, Donal Cullinan, who's the Director of Insurance Supervision, noted a number of interesting observations in relation to the ORSA. So first of all, he noted that the ORSA hasn't been fully embedded within decision-making and planning processes. And also he said that there's been little evidence of engagement at board level. So if you think back to when they were introduced, I think it was intended to be almost the heartbeat of Solvency II. Firms were really meant to rely on the ORSA to inform any decisions that they were going to make, whether it was about, launching new business lines, new products, repricing products, making decisions in relation to underwriting and reinsurance decisions and so on as well. And it appears from what the CBI said last week that they don't think that that's actually happening in reality. So there's going to be a challenge to companies to satisfy the CBI that they are using the ORSA appropriately. Likewise, as with everything in Solvency II, I guess the ORSA is really meant to be steered by the board. And certainly for companies we've worked with, we've seen the board take an active role in reviewing the proposed ORSA scenarios, challenging their validity, and also reviewing and challenging the output of the ORSA as well. But the CBI doesn't seem to share that view. So again, there's a challenge for companies there to show that boards are actively involved in the entire ORSA process. The next thing that Donal Cullinan noted, and it kind of comes back to the point I made on the previous slide, is that COVID-19 has kind of reinforced that the ORSA needs to consider a wide range of stresses, different stresses that occur at the same time, the impact of stresses not only on solvency but also on liquidity, considering combinations of stresses that we haven't previously experienced or combinations of stresses that we previously might have considered were too low a likelihood to actually consider in ORSAs. And he also noted that ORSA should consider group dependencies as well. And that's something, I suppose, that ties in neatly with recovery and resolution planning as well, where a lot of companies possibly rely very heavily on groups in certain circumstances, and the CBI is kind of challenging that reliance on groups in certain circumstances as well. So they're reinforcing that message that you can't necessarily just assume that your parent can always bail you out, and you also might need to consider concentration risk or over-reliance on group functions and so on as well. And likewise, just on the topic of recovery plans as well, then Donal Cullinan just noted that there are kind of parallels and overlaps between the ORSA and the recovery plans that Patrick mentioned on his slides as well. Just prior to the CBI's insurance industry briefing, about a month or 6 weeks ago, they issued their 2020 insurance newsletter, and that covered a lot of the same themes in relation to the ORSA in terms of considering various stresses and so on as well. So I won't dwell on the detail on this slide. I'll just draw your attention to maybe two particular points. The first is just in relation to the third bullet on this slide, where it notes that where firms face potential claims which are subject to a range of possible outcomes, they should consider worst case scenarios. And the example the CBI gave in its newsletter is business interruption claims that are under litigation. And obviously there's been a lot of focus from the CBI on business interruption this year. Also, we've seen a number of high profile court cases of late. So I think that probably just goes to show that the CBI is watching this area closely, and that they're encouraging non-life companies not to assume that they will win those court cases, but to plan for the worst, a loss of those court cases and a potential increase in claims as a result of that, which could be very onerous for a number of non-life companies. Maybe just kind of going off topic a little bit, but just while I'm talking about non-life companies as well and ORSA considerations, the other thing that the central bank has been looking at a lot this year in terms of non-life is in relation to pricing. And the CBI hasn't finished its kind of investigations into these areas at the moment, but clearly it's a topic that they're focused on, and maybe companies need to start considering that in their ORSA. Maybe they'll need to consider potential changes in their price optimization approach, and that could impact things like, premium rates, premium volumes, retention rates, and so on for non-life companies. So maybe that's something that companies also need to consider. And the final thing I'm just going to note on this slide is the last bullet point there, which talks about companies need to consider if there has been a change in their risk profile to the extent that the results of their previous ORSA are no longer relevant, and they should really update their ORSAs. So Again, if you look at what Solvency II says, it requires companies to perform non-routine ORSA if there has been a change in its risk profile. And I suppose maybe that's a question, did companies do that earlier in this year when COVID-19 started to materialise, or didn't they? I think the CBI is kind of challenging companies to make sure that they keep their ORSAs up to date and keep them fresh. Moving on then to COVID-19 in particular, I prepared these slides initially a couple of weeks ago, and at the time I thought it was a safe bet that COVID-19 was going to be with us for a long time to come. Thankfully, there is some light at the end of the tunnel now. We have seen in the press the last couple of weeks, 2 different vaccines have been announced, both of which seem to be very effective against COVID-19. However, I think it's a safe bet to say that, it's going to take a while for those vaccines to be rolled out to everybody in society, and that COVID-19 will be with us for a good chunk of 2020 at least, or 2021 at least, apologies. So I suppose that begs the question then, how do you allow for that in the ORSA? We would expect that most companies will have a base case which will include their best estimate of what future experience is going to be in terms of claims, market movements, and so on, looking into the future. But we'd also expect then companies to consider adverse scenarios and allow for uncertainty in their ORSA stresses, potentially maybe as well on a combined basis, because as we've seen, COVID-19 led to a number of different adverse things occurring at the same time. And not only do we think companies should allow for a kind of uncertainty in relation to their assumptions for claims and so on, but they might also need to allow for uncertainty in relation to timing. So, for example, what happens if the virus takes, or if the vaccines take longer to be rolled out, or what happens if there's a delay, there's some last minute side effects determined as a result of the vaccines, and they're delayed, and COVID is with us going into 2022 and beyond. We think that's something that companies will need to consider in their ORSAs as well. I'm not going to dwell on this slide. This is just a list of potential areas that we think companies would need to allow for impact on demographic factors or claims rates in consideration of COVID-19. And likewise, this next slide just looks at considerations in relation to the market impacts that COVID-19 has had so far and could have into the future. For example, if you've followed the equity markets, they've done all sorts of weird and wonderful things this year as countries have entered and exited lockdowns and as vaccines have been announced. So you'll need to kind of allow for a lot of uncertainty in equity markets going forward and so on as well. And finally, there are another number of other impacts of COVID-19 that companies are likely going to consider in their ORSA as well. So, for example, what are the impacts on new business volumes? Are we going to see a dip in certain premium volumes because people aren't able to afford them, or an increase in premiums for additional covers that people do realise they need as a result of the impacts of COVID-19? Are companies going to change product designs maybe to make it clearer in policy wordings that they're not on the hook for pandemic risk or something like that? Companies' business models might change. For example, there might be more of a switch to digitalization and the impact that can have on companies' business models, commission structures, and so on going forward. Companies might also want to consider changes to their reinsurance arrangements to protect them for risks that they hadn't realized that they were exposed to. And then I guess with everybody working from home at the moment, there's maybe slightly more of a lack of oversight than there would have been in people's work previously. That maybe could lead to increased operational risk as well. Finally, I suppose just in relation to COVID-19 then, the CBI came out earlier on this year and it kind of, I suppose, mandated really that companies should postpone any dividend payments while there was a large degree of uncertainty in terms of the impact of COVID-19. They've recently come out in their COVID-19 frequently asked questions on their website, and they've softened their stance a little bit. They've now said that where the board of an insurance company is of the view that a high degree of certainty has been reached and they want to pay a dividend, that they should engage with the CBI before proceeding to pay that dividend. And as part of that engagement, they need to demonstrate satisfactory forward-looking solvency, liquidity, and operational risk positions. So as soon as anything forward-looking is mentioned, I think that straight away should remind people of the ORSA. So I would expect that for any companies that are intending to pay dividends anytime soon, the ORSA is going to be a key tool in satisfying the CBI that they're in a position to pay dividends. And that's something that companies might need to consider in terms of the wording that they put into their ORSA reports, or the degree of rigour that they put to their ORSA this year, just to make sure that they're going to be in a position to pay dividends. And I suppose also that begs the question, if CBI approval is needed before companies can pay dividends this year, should they be actually allowing for any dividend payments in their ORSA, or should they be kind of allowing for postponement of dividends into the future, which might boost own funds in the short term, but might have implications for additional capital requirements in relation to counterparty default risk or something like that. As I said at the start, Patrick's already touched on the Solvency II review, so I'm not going to go into detail on this slide, but just to note that this is another area that could have implications for companies' ORSA, because, you know, generally in the ORSA and companies' business plans, they're looking out maybe 5 years or so into the future. And looking at the results of Patrick's poll, it looks like most people believe that the Solvency II changes will have been implemented at that stage. So any company that feels that they're materially impacted by those changes that are proposed under the Solvency II review might want to consider those impacts in their ORSA sooner rather than later, so that they're prepared for any adverse impacts and can start planning any risk mitigation actions as a result of that. Climate risk is another topic that I think people need to start considering in their ORSA sooner rather than later. Last year, the CBI's newsletter pretty much came out and said that they expected companies to start considering climate risk in their ORSAs. And recently, EIOPA has come out with a consultation on the supervision of the use of climate change scenarios in the ORSA. And I've just taken a quote here, which is kind of from the introductory text to that consultation paper. And it says that supervisors should expect insurers to subject material climate change risk to at least 2 long-term climate scenarios where appropriate. So that might be something like, you know, transition risk, where we're seeing impacts on markets for some companies, but for some companies there will be direct climate risks in terms of, you know, increased exposure to flood risk and droughts and so on as well. So that's something that the CBI and EIOPA expects companies to start considering in their ORSA sooner rather than later. Next, just to touch on Brexit, I guess the main point to note on Brexit is obviously we're in the transition period at the moment. It ends in less than 2 months' time, and yet there's still a lack of clarity on trade agreements and so on going forward. So there is still scope for Brexit to have implications for companies, and they need to consider those in their ORSA going forward. I think most companies are probably clear in terms of their business models for selling into the UK or from selling business into Europe from the UK. But what about other agreements with custodians, banks, things like that? And does Brexit have an opportunity to impact the financial markets? I think those are some questions companies should be considering. And then there's also the question of Solvency II equivalence. Will the UK and the Solvency II requirements diverge over time? And what could the implications be for group reporting and for reinsurance and things like that as well? On a slightly different topic then, Patrick again mentioned the CBI consultation paper on recovery planning earlier on. And I think the CBI acknowledges that there are a number of key links between the ORSA and recovery plans in terms of performing stress and scenario analysis, and also aligning certain capital indicators as well. So people will need to start considering that in their ORSA processes going forward as well. And this is just to note then that some colleagues of ours in the UK produced a very interesting briefing note on the topic of COVID-19 and ORSA considerations earlier this year. And if you're looking for more information on what you should or could consider in relation to your ORSAs, I'd recommend that paper. I think it's well worth the read. So that's everything from me. I'll just go back to the results of the polls that we discussed at the start. So the first question was, lead to significant changes in the ORSA scenarios in 2020? And 58% have said that yes, they did, and 41% said no. So I guess now that we've seen what the CBI's views are in terms of maybe using COVID-19 and considering some of the impacts of COVID-19, the ORSA, it might be an opportunity for those people who haven't really made changes in their ORSA this year to consider making future changes in future just to satisfy the CBI's expectations in that space. And then just that brings us on to the next question, which is in relation to kind of forward-looking and the ORSA in 2021. And it looks like the majority, 44%, plan to examine similar scenarios in 2020. 37% think it's too early to say. 7% expect less severe scenarios, and 11% expect more severe scenarios, which is somewhat surprising, because I think the general consensus for many people has been that COVID-19 has had less of an impact than maybe initially expected, but that just goes to show that there can be different nuances in different individual lines of business. But again, I think it's stark to note that most companies aren't expecting to make changes to their scenarios next year. I think, again, having seen what the CBI's views are and maybe considering other things like Solvency II and the CBI and EIOPA's views on climate risk, that's something that companies may wish to reconsider going forward, just to make sure that they're keeping on top of regulatory expectations. So with that, I'll wrap up, and I will hand you over to Eamon Phelan to talk to you about key risk indicators.
Thanks very much, Owen. Okay, I'm going to take a look at something a little different. So key risk indicators. We won't have any reference to Solvency II, ORSA, COVID-19, all of those key topics. Instead, I want to look at KRIs. So as you're aware, KRIs are very broadly used within the risk management of insurers, but generally there's a lot of scope for improvement in how they're used. I'm specifically going to look at how we might set up a more effective key risk indicator framework, looking at the design, calibration, and reporting aspects of KRIs. This is before maybe I get into the detail, just to note that this is building on a research note that we've just published. It's available online as of today, and we'll be adding a link to this deck afterwards when it's circulated to everybody. When it comes to considering the design of KRIs, it's important to maybe take a step back initially. So KRIs, similar to risk management generally, is not just about preventing failure, about trying to minimize the level of risk that the company is taking on. It can also be about trying to identify opportunities and to maximize those opportunities in order to aid the company in meeting its strategic objectives. And this is a key part of unlocking the value proposition of KRIs. So we want to avoid unwanted surprises, sure, but we certainly want to make sure that one of those unwanted surprises is not that we've missed an opportunity that was there. So there can be great opportunities that we need to recognize and be a little lower or trending downwards in given areas. It might give us the opportunity to take on more risk in other areas. The KRI framework certainly needs to be forward-looking. During a crisis management situation, it needs to be dynamic, and that can help us to act in a timely manner and to map out in advance what it is that we would do in response to developing situations. KRIs can give us a common risk management thread through the organization as well. So, for example, we'd have areas like risk appetite, emerging risk, operational risk management, recovery planning, and so on. And KRIs can give us a common read across these different metrics in the organization in order to make sure that everybody is understanding the key messages, staying engaged, and acting in the same direction. A health warning, though, when it comes to KRIs is to make sure that our KRIs don't just become KPIs, so that they are forward-looking and not just reporting on things that we know are after happening in the past. That can certainly be a major pitfall when it comes to KRIs generally. Just trying to advance the slide. Okay, so what does good look like when it comes to KRIs? So we mentioned, I mentioned a moment ago around having an integrated and coherent framework across the organization. We need to make sure that we're getting a common message. So if, for example, we're looking at operational risk management and we're seeing that things are trending okay, we then shouldn't be looking separately at risk appetite and seeing that maybe we're close to having a breach in relation to operational risk exposure. You need to make sure that there's buy-in from the key stakeholders in the company. And we can only really get that if we understand what it is that is important to those stakeholders. So we need to make sure we're looking at the right risk exposures, so the things that are most important to the key individuals, key functions in the company. And that we're not just cluttering up the reporting dashboard with unnecessary information. We need to have a forward-looking framework. It needs to be dynamic, so it needs to evolve as the position of the company evolves and the external environment is changing. We need to make sure that it's informed with the latest available information and allowing us to make informed decisions on the back of it. We also need to make sure that there's a common understanding coming out of the KRI framework. So if we're being told that risk needs to be managed, everybody needs to understand, well, what is it that we might be going to do as a result of that. And it should be automated insofar as possible. We don't want to spend all our time updating KRI frameworks and then not have enough time to actually act upon the messages that we're getting from them. When it comes then to designing, there are top-down and bottom-up approaches that we can follow. It depends really on what it is that we're trying to achieve here. But in relation to creating a coherent framework, one that identifies the key risks of the company and the key underlying drivers, I generally think that the top-down approach is preferable because it gives us that holistic view of the organization. So looking at a top-down process, the initial step here is identifying the key risks. And we can go to some of the usual places for assessing the key risk exposure. So the ORSA, the risk appetite statement, the risk register, maybe the emerging risk management framework. But we also need to involve the key stakeholders, and we can do that through workshops, brainstorming sessions, consulting with the key functions throughout the organization to see what is it that's top of the agenda for them. Once we've identified the key risks, we then need to peel back the layers to try to understand, well, what are the underlying drivers of those risks? And once we've identified those drivers, what are suitable risk indicators or lead indicators of our risk exposures in those areas? Wrapped around that, then we should have an effective risk reporting framework. So in order to delve down beneath the key risks to understand what the key drivers are of those risks, we use a process called causal mapping. So if we were to take, for example, the solvency risk in a company, try to understand, well, what are the underlying drivers of that risk exposure. We can have, for instance, market risk, underwriting risks, counterparty operational risks. So they give us a little bit of insight as to where the risks lie. Then beneath that level, say on underwriting risk, we can drive down to see, well, there's lapse risk, there's mortality, there's longevity, there's expense risk, and so on. Again, that gives us a more granular understanding of where the risks are coming from. But we then need to look even beneath that level. So sticking with the example of lapse risk, we can explore, well, what are the underlying drivers of lapse risk exposure for the company? So as an example here, we can have, for instance, policyholder fund returns, the insurer's reputation, the competition in the market, the state of the economy, the tax regime that policyholder faces, and so on. So this gives us a much richer picture of what it is that's contributing to the risk exposure. So to filter that out a little, we can take, say, policyholder fund returns as one of the more important causal drivers of the lapse exposure. And it in turn then will be affected by a number of different factors. So for instance, the returns the policyholder has achieved since inception of the policy, the expected future market interest rate levels, volatility in the market. If we take, for instance, then expected future market interest rate levels as a key driver of overall policy fund returns, we can choose the yield curve as a suitable lead indicator. So monitoring the yield curve will give us a forward-looking indicator that we can use in order to anticipate where policyholder fund returns are headed. So just to take a step back from that specific example for a moment and just look at a calibration of risk levels, there are two different considerations here. So we can have, for instance, specific KRIs that that we want to monitor. So just at an individual level. So for example, the interest rate level that we talked about a moment ago. But also certain risks may have multiple KRIs associated with them. And we need some way of aggregating those KRIs in order to get a read on what the risk exposure is for that particular risk. And I'll come to an example of that. So for calibrating individual risk levels, we can use something like a red, amber, yellow, green system, or a more simple red, amber, green, in order to allow us to trigger action in a timely manner and to escalate things through the organization when the time is right. So we should be able to tie this in with the likes of limits on our risk appetite, limits maybe on recovery plans, and so on. But there doesn't necessarily have to be a straight correspondence between, say, red on your KRI framework and red on your risk appetite. Instead, you should be hitting red maybe on a KRI framework when you would be getting to an amber on your risk appetite, because the idea behind the KRI framework is that it's a lead indicator. It gives you time to act, and that you're not waiting around until you've had a breach of risk appetite before you actually try to do anything about it. We can have quantitative as well as qualitative measures then when it comes to setting these limits. It's certainly more commonplace to have quantitative levels, so we just set a numerical level, and then whether we're below, at, or above that, we can set our limits accordingly. But we can also have a qualitative measure if it isn't really possible or clear what the quantitative measures might be. So we might look at whether or not an event has occurred, whether it's been identified, whether it's been escalated through the organization. We could use, for example, if there was a rule change or a legislative change coming in, whether or not the legislation had been consulted upon, whether it was being drafted, whether or not it was just awaiting implementation, and so on, just as different ways of deciding when it is that we might need to act. So back to our example on lapse risk. Again, we identified policy fund returns as being a key driver of lapse risk, and then drill down to ultimately select the yield curve as a lead indicator of our exposure there. So we can calibrate that in two ways. We can either look at a retrospective or a prospective approach. So the retrospective approach would look at levels that the yield curve had been at in the past and what the corresponding solvency requirement of the company was at each of those points in time. Of course, that suffers from a couple of drawbacks. We have maybe additional noise that gets introduced because we're taking measurements at different balance sheet dates in the past. It can also be a limited range, maybe in which the yield curve has been moving over the past number of quarters, a number of years. And that can restrict our ability to fully calibrate the range of the KRI. So instead, if we have a good predictive model, we can use varying levels, theoretical levels and shapes maybe of the yield curve, input those to the model and see what that means for the solvency capital. That can give us a much cleaner calibration. So any individual KRI then can actually be used for multiple risks, not just sort of a single purpose use. So in the case of the yield curve, we've gone through how it might be used for lapse risk exposure. Similarly, though, it could be used for market risk, used for new business risk. Then in the case of market risks, you might need to combine it with other KRIs in order to get a proper picture. So, and the same goes for lapse risk. So in the case of market risk, we might want to look at interest rate volatility, equity volatility, as well as interest rate levels. So we need some way of combining those. I have an example here covering liquidity risk. So we've got 4 different individual KRIs, each giving part of the picture on the liquidity risk exposure of the company. And we need a way in which we can aggregate those. So an example might be, well, if 2 of the individual KRIs are trending yellow, we might go for a yellow at an aggregate level. 3 of them are yellow, it might mean amber. If some of these KRIs are relatively more important than others, well, we can factor that in as well. Say if the spread on bonds was by far the most important indicator of liquidity risk, well then if it went yellow or went amber, it could trigger a red overall at the aggregate level. We can also look to aggregate by time period, so the numbers of yellows or ambers that we might have observed over a given time period on our individual KRIs can then be used in order to assign a rating to the aggregate KRI. Looking then quickly at reporting, I think many of us will have seen this sort of dashboard from time to time, so it's a sort of spreadsheet-based approach, hugely rich in information in some ways, but very technical and maybe lacking in a lot of information in other ways. And in order, I think, to improve effectiveness of reporting, there are a number of different rules of thumb that we need to keep in mind. So firstly, think of your audience and their needs, so that what you'll come to the board with, or the risk committee, could be and should be probably vastly different than what you'll communicate to the first line functions. You need to keep the message simple and consistent. This is going to be very, very much important consideration when it comes to clear communication and consistent understanding through the organization. We need to consider if an action plan is going to be needed. So will the issue correct itself, or do we actually need to proactively do something about it? And we'll have more on action plans in a moment. We should think about mixing visuals with the numbers. So don't just present a huge array of numbers. Maybe there are charts, radar charts, trend lines, bar charts, pie charts, and so on that we can use in order to break things up, maybe bring a little bit more life to the numbers and to highlight what's specifically important. And it's useful to provide frequent updates, real-time if possible, and to use resources efficiently and to automate this reporting process as much as possible, so that we're not spending so much time producing the numbers and reporting them, but rather doing something about them. On action plan reporting then, and this is something that's maybe aligned with recovery planning requirements that are coming in. What are the predefined actions for each trigger level? So we don't just sit around and wait for KRI to trigger and then wonder what to do. We sort of just need to reach for predefined, pre-agreed actions so that we can act in a timely manner. Are there multiple actions maybe needed to address a single KRI, or will a single action do? Is the issue just specific to the company, or is it systemic through the industry? And the responses that we have will be quite different depending on the nature of the issue. And what are the costs and benefits of the proposed action, and indeed the time frame over which the action can be carried out? So these are all very very useful things to consider, and certainly to flag as part of the KRI reporting dashboard. So back again then to what good looks like. So as a quick reminder, again, this can be used very effectively to sense check our existing KRI frameworks for overall effectiveness. But hopefully the different considerations on calibration, design, and reporting that I've just gone through will give you some ideas as to how to enhance your existing framework under these headings. So that I think brings me to the end of my piece on KRIs. I'm going to pass back now to Aisling. We'll take some Q&A.
Thank you very much, Eamon, and thank you to Patrick and Owen as well, all our speakers today. We appreciate you all putting on a shirt and tie for the occasion, or just a shirt in some cases, but that's okay. I believe the email capture at the start of our briefing didn't work, so if you want to record this for CPD purposes, I've put a link in the chat that hopefully you can click on to record this session for CPD. We've had a few questions come in. If you want to ask one now, just below the chat, there's the option to ask a question and to click on a blue button. So if you submit your questions there, I can put them to our panel. So the first question I have is for Patrick. So you might want your rowdy audience to pipe down there, Patrick, while I ask you a question. So we have a question: is there any indication of additional disclosures in the 2020 SFCR relating to COVID-19 from the Central Bank of Ireland?
So I think so far I haven't seen anything official on it. But I suppose in all likelihood you would expect that companies should be saying something about it. I suppose cast your mind back to March of this year, that supervisory reporting flexibility note, the one where they pushed back all the deadlines. In that, they did also say that there's an expectation that there'd be text about COVID-19 included in companies' SFCRs. So I imagine the same will be the case this year end. So I think companies can probably bank on that being the situation. And remember as well, the SFCR is quite a set template and different sections you need to have. So really it's just a case of kind of putting in commentary around this in maybe sections like there's profile section or your business performance section.
Thanks, Patrick. Yes, I think it's certainly hard to ignore. Okay, and then next I have a question for Owen. And I think it's a question that will apply to anyone completing an ORSA this year, that given all of the things really that people are expected to cover in the ORSA, what is the ideal number of ORSA scenarios?
Yeah, I think that's a good question. And obviously there isn't a one-size-fits-all answer to the question. What we've generally seen in the past is the number of scenarios that companies test probably range between 5 and 10. I'd imagine, generally speaking, we're talking about 6 or 7 or maybe 8 scenarios would be standard enough across the companies that I've seen in the past. I think the one thing I would say is, even though there's a lot of things that people are required to consider in their ORSA, sometimes one scenario can cover a multitude of things. So if you take, for example, some of the climate risk impacts, things like the transition risk that can affect market values, companies are already probably looking at a number of other market impacts anyway in some of their shocks, and they can maybe just double up on the commentary and use one scenario to cover off both a climate shock and other shocks that can affect market risks. And the same can be true of a number of other things as well. So you can have maybe a shock that looks at an increase in expenses, and an increase in expenses can double up as a kind of a regulatory fine or something like that as well. So there are ways that you can keep the number of scenarios relatively modest, but still cover off an awful lot of risks.
Thanks, Owen. Yes, I'd agree that obviously you don't want to have too long a list of scenarios and try and keep them short, but to capture as many risks as possible would be ideal. And next we have a question for Eamon. So one each so far. If anyone does have any other questions, please feel free to send them in. We have a couple of minutes left. And it's probably similar, I guess, in that how do we balance the CBI's expectations where we need to, they're expecting companies to have a certain number of KRIs, but you also want to have genuine KRIs that will actually trigger some action. And do you have any suggestions there?
Yeah, and I think the key issue here is around the genuine KRIs. So the company really needs to look at its risk exposures and look at what's important to the key stakeholders in the business and to design the KRIs around that. Okay, the CBI is going to have expectations there, but I don't think the CBI can expect more than companies doing a good job and keeping an eye on the key risks that face them. Certainly the CBI has had something to say recently around KRIs and recovery planning, but again, that's more to the purpose to which we put the KRIs rather than the actual KRIs themselves. So yeah, I think companies just need to go from first principles, look at their own risk profile and design the KRIs accordingly. I think the CBI ought to be happy with that then.
Okay, thank you, Eamon. I don't think we've any more questions coming in. I guess the common theme I saw in those was balancing CBI's expectations with practicality, and that's a balance that we're all trying to achieve all the time. So thanks again to all my speakers and to the audience today. And if you are looking for CPD, please do click on the link in the chat window there, and we will be circulating an email afterwards with slides and a survey. And given our new approach today, we'd be particularly interested in any feedback and how that has worked for you. So thanks again, everyone, and we'll speak to you all soon.